Welcome back to Investing Talk Podcast. Today, we are focusing all of our analytical energy on a cloud content management leader, Box. The question we are seeking to answer, based on the research you provided, is simple. Is Box a good time to buy now?
Yeah, that's the big question. We've got a stack of recent earnings reports, fundamental analysis, competitive intelligence, and technical forecast to unpack here. We'll be looking at everything from their, spectacular net income growth to their standing against the industry giants. It's a really interesting setup.
Okay, sounds good. Before we get started, please take a moment to subscribe, like, and comment. Your support really helps us bring you more analysis like this. Also, if there's a specific company you want us to look into next, please leave a comment below. We definitely want to hear from you.
Okay, let's unpack the fundamentals then. Box is generating over $1 billion in revenue, which, is solid. But the growth and profitability is what immediately stands out, right? That's absolutely right. That's the headline here. So for fiscal year 2024, revenue was $1.09 billion. That's a steady year-over-year increase, about 5.05%. Nice, but not earth-shattering. But here's where it gets really interesting. Net income grew substantially to $201.57 million. That marks a 103.3% increase from the prior year. Just massive.
Wow, okay, 103%. That's a huge jump in net income, especially for a company like Box in the SaaS space. How did they manage that level of operational efficiency? Was it a one-off, or is this something structural?
It really signals strong operational leverage. It looks structural. They've hit a point, it seems, where adding revenue costs them less. The trailing 12 months net income margin is sitting around 16.6%. Now, for context, that's robust. It's well above the average for the SaaS industry. Generally, it tells you management's been effective at, optimizing costs.
So they kind of tightened the belt and found efficiencies. What does that mean looking for? Are analysts expecting this to stick?
Yeah, the consensus is definitely bullish. Analysts are projecting a 12-month forward EPS near $1.37, and that's based on continued margin expansion. And financially, the company looks pretty healthy overall. The balance sheet shows low leverage. Their enterprise value is quite close to the market cap, around $4.74 billion. That basically indicates no significant net debt burden, which is great. Makes them resilient.
Right, resilience is key. And when we talk about financial health, you have to look at cash flow. Cash is king, after all. What's the FCF situation?
Oh, the free cash flow yield is compelling. It's at 7.1%. That gives you a price to FCF ratio of about 14.1, which is, pretty attractive. It means they're consistently generating quite a bit of excess cash, and that provides ongoing capacity for R&D, maybe more AI stuff we'll talk about, or shareholder returns like their buyback program. It gives them options.
Okay, so the financials look strong. Good profitability, good cash flow. But, in cloud software, the competitive landscape is just brutal. What's keeping their customers loyal? What's their defense against, say, Microsoft or Google?
That's the core strategic question, absolutely. Box has carved out a niche, basically. They remain a leader in secure enterprise-grade cloud content management. They have a pretty entrenched customer base, especially in those highly regulated sectors. Think finance, healthcare, government, places where security and compliance aren't just nice-to-haves, they're essential.
Okay, so specialization is their angle. But why is their security stickier than, say, what Microsoft offers bundled in?
Well, it comes down to depth and focus, really. Box isn't trying to be everything. They're laser-focused on being the most secure content layer possible, and they keep innovating there. Things like e-signature, workflow automation, and crucially, their AI integrations. They recently announced Box Shield Pro. That's an AI-powered content protection solution. For CEOs managing sensitive data, that kind of specialized AI-driven security is a big deal. It's a key differentiator.
And is that differentiation actually keeping customers around? Does the data back that up?
It seems to. We look at a couple of things. First, net revenue retention is trending near 106%.
Meaning existing customers are spending more?
Exactly. 6% more year over year on average. And second, the latest quarterly filings, the Q2 FY25 10Q, confirms customer churn is minimal. When existing clients stick around and spend more, that validates your strategy, right?
Makes sense. Okay, great fundamental story, strong strategic positioning in their niche. But, as investors, timing matters. What are the technical signals telling us? Is the market recognizing this strength?
The technical picture definitely seems to be confirming the fundamental story. Over the last 3 months, we've seen a pretty clear bullish trend in the stock price. It's showing those classic signs, higher lows and higher highs. That suggests investors are, accumulating shares. Accumulation seems ongoing.
And what about key indicators like moving averages? Where does it stand relative to those?
Right now, Box is trading above both its 50-day and its 200-day moving averages. Those are both converging somewhere near $32.50. Trading above both is generally a strong signal of ongoing bullish momentum, short and longer term.
So $32.50 is a key area. Where's the immediate support and resistance people should watch?
Yeah, that $32 at $32.50 zone looks like key support, reinforced by those moving averages. If there's a pullback, that's the level to watch. On the upside, resistance levels seem to be between $36 and maybe up to $38.80. A clean break above $38.80 could signal a significant next move higher.
Okay. And you mentioned the RSI, the Relative Strength Index, earlier. It's at 63.9. Can you unpack that for listeners? Why is that level significant?
Sure. So the RSI measures momentum. Typically above 70 is considered overbought, meaning the buying might be exhausted, risk of a pullback. Below 30 is oversold. So 63.9 is, well, it's in the bullish zone, confirming strong momentum. But critically, it's not overbought yet. It suggests the rally has steam. There might still be room to run before it gets overheated just based on momentum alone. It's kind of a sweet spot.
Right. Strong, but not stretched. Okay, so the technicals are lining up nicely with the fundamentals. Let's connect this to the bigger picture now. What are the market drivers? And crucially, what risks should listeners be keeping an eye on?
Well, market sentiment is definitely positive right now. It really picked up after the Q2 results back in August 2025. That was an earnings beat better than expected, driven by strong enterprise upsells and that margin expansion we talked about. That beat immediately got analysts more optimistic, leading to target price raises.
How bullish are we talking on Wall Street? And what about institutional money?
Pretty bullish. The average analyst price target suggests something like 16–17% upside from where it is now, and 8 out of 11 analysts covering it rate the stock a buy. But here's a really interesting data point from the research. Institutional ownership is remarkably high. It's at 108%.
Wait, 108%? How does that even work? What does that tell us?
Yeah, it sounds weird, right? It basically means institutions, big funds, hedge funds collectively own more shares than are technically outstanding. It usually happens through complex factors like overlapping holdings or shares held short that were then bought back. But the takeaway, it signals extreme high conviction from the so-called smart money. These large funds are very confident in Box's prospects, and related to that, short interest has also ticked down a bit, meaning fewer people are betting against it.
Okay, so high conviction from institutions. That's a powerful signal. What about near-term events? What catalysts should investors watch for in the next few months?
There are a couple of big ones on the radar for the next, say, 3 months. First, Box has been teasing a major update to their workflow automation tools, integrating more AI features. That's expected before the end of the year. Given the market's focus on AI, that could be a significant driver. Second, the next earnings report is coming up. Q3 FY25 results are expected in early December 2025. The consensus is looking for continued year-over-year growth in both revenue and earnings, building on that Q2 momentum.
Anything that might put a slight damper on those Q3 numbers? Any known headwinds?
Yes. Actually, this is where you need to read the footnotes sometimes. Their big customer conference, BoxWorks, got shifted on the calendar this year. It moved from Q4 into Q3. Now, these events are important for long-term engagement, but hosting it costs money. So there's going to be about a $3 million expense headwind hitting Q3 operating margins, specifically because of that timing shift. It's temporary, shouldn't affect the long-term story, but people need to be aware so they don't misinterpret the margin number when it comes out.
Good flag. Okay, we always need to talk risks.
Yeah.
What are the main potential downsides here, especially thinking about sustaining those margins?
The main risk, the ever-present one, is just the intense competition. Microsoft, Google. These giants can bundle features or compete aggressively on price. Box's defense is that specialization in security and compliance, hitting specific high-margin niches, but they have to keep investing heavily in R&D to stay ahead. It's a constant battle.
And any external risks, things outside their direct control.
Yeah, international exposure is one to watch. About a third of their revenue comes from outside the U.S. And critically, about 65% of that international revenue comes from Japan. So that exposes their reported results to currency fluctuations, particularly movements in the yen. They try to hedge, but FX volatility can still impact the numbers you see.
Okay, competition and currency risk. What about speculation? Is the market viewing Box as a standalone story, or is there M&A chatter?
There is persistent, though unconfirmed, speculation that Box could be an M&A target. Yet for a larger enterprise software company wanting to buy their way into that secure cloud content space and grab that valuable enterprise customer base. And frankly, the financials we discussed, the low debt, the strong free cash flow, make them a pretty attractive, digestible target for a bigger player. There are also rumors about them potentially expanding their share buyback program, which would also be a positive for shareholders, separate from any M&A idea. So pulling all this together, the analysis points to an overall bullish rating. We're talking maybe an 8.5 out of 10. That's based on that accelerating earnings growth, the high margins from operational leverage, the positive technical momentum, those near-term catalysts like AI and earnings, plus that strong institutional backing.
And 8.5 is quite strong. It sounds like the analysis suggests Box could appeal to different types of investors then. Maybe short-term traders looking at catalysts like the AI launch or Q3 earnings, but also long-term folks focused on those sticky customer relationships and the compounding free cash flow.
Exactly. It seems to fit both profiles, potentially. Which leads to maybe a final thought, a question for you, the listener, to consider. Given that fierce competition and the reality that 100% plus net income growth is really hard to sustain long term, how long can Box keep winning with just differentiation? How long can that strategy of deep security and AI, like Box Shield Pro, keep driving this kind of profitability before perhaps the economics make an acquisition almost inevitable? Something to think about.
That's a great point to ponder. Thank you for joining us for this analysis today. We hope this exploration of the source material has given you valuable insight into Box. Remember to subscribe, like, and comment to support the Investing Talk podcast, and definitely let us know what company you want us to look at next time.